I'm going to go over the state of the commercial lending markets. I think generally I would say that banks are very positive, looking for growth, looking to put on assets for quality companies. And I think the backdrop to that is that U.S. domestic companies are very healthy right now. So as we kind of look at where we are in the cycle and you look at U.S. companies in general, they're fairly healthy. But there's some undertones that are out there. And so I think setting the macroeconomic tone for what's out there and what banks are focused on, makes sense. So first slide here, just general macroeconomic outlook. U.S. GDP growth rates have slowed. Concerns in the Eurozone, particularly with regards to Greek economic turmoil. There's been a pullback in the Chinese consumer and manufacturing sector, resulting in the yuan devaluation. Domestic unemployment, this says 5.3, but it's 5.1%. It's lowest since the Great Recession. U.S. dollar is gaining strength. Unfortunately, we don't foresee a material improvement in oil prices over the near term. Last year at this time, we kind of saw the forward curve up and to the right. I think if you look at forward strip pricing today, it's more flat. And this is really due to supply and demand dynamics that are out there, increased Saudi production, and then, less demand out of places like China. Volatility remains in the global equity markets, and so we're seeing market fluctuation and negative indicators out of China. And then I think what is worth hitting on and is worth out there is that banks in the last couple of years have devoted a significant amount of resources, both human and financial, towards regulatory compliance. It started with Dodd-Frank, and then now with the Consumer Financial Protection Bureau. There's just a lot of regulations, a lot of infrastructure that banks are having to put into back office and compliance capabilities. So turn into the next slide here. What's going on in the real estate market? Trying to take this from a national level, but also I know here in Houston, what's going on? What are banks doing? Low vacancy rates and an expanding economy have driven real estate activity across all sectors. Over the last 3 years, 22% of national banks have experienced over 50% growth in their commercial real estate assets. This robust supply of new supply is beginning to temper lender activity towards new projects. Recent healthy financing markets have caused many banks to reach or nearly reach exposure levels on construction-related loans. Despite the dynamics in the energy market, Houston new home sales remain ahead of last year's pace and actually lead the country still. We have seen a slowdown in office leasing activity. What does all this mean for banks in general and lending activity? I think banks are still very much open to doing new commercial real estate projects. They're very careful on what the structure looks like, loan to cost, loan to values, and location is very important as well. But banks are very open to real estate lending still. Moving over to energy and energy lending. We talked about it, oil prices have remained low due to Saudi production. Saudi oil rig counts are up, and they've actually increased production year over year. I don't think anybody forecast a material price improvement, and so we're kind of in a new world of depressed oil prices for a while. With regard to energy service providers, we expect top-line revenue and margin declines, and we really think that's going to show up in Q2 and Q3 numbers. As you look at Q1 results for a lot of the energy services providers that we see, the backlog was there and there was still revenue and margins were fairly hanging in there. But as we get into Q2 results and Q3, we think the volume's down and margins are going to be depressed. To date, M&A activity has been slow in the E&P sector. This is a result of actually heading in, starting late last year, when oil prices declined, many producers were well hedged going into 2015. And so as those hedges roll off for the producers out there and they need additional capital, we think the back half of the year is actually going to be some opportunity for some M&A activity in the E&P sector. And banks remain open for E&P loans and midstream loans out there. And it's really a function of the borrowing base, price decks, et cetera. But banks are absolutely still open for new business. It's just not going to be at 2014 levels. Behind all this in the energy sector, and I think what may drive M&A activity and others is we estimate there's about $50 billion of capital on the sideline targeted for the energy sector. We think about $20 billion of that is targeted towards hard asset sales, and another $30 billion looking for distressed paper, et cetera. Bank regulators in this current price environment have definitely stepped up their focus on energy books. Right now, they've really focused that primarily on the E&P sector. And we've seen a renewed focus and actually coming in and reviewing loans a couple times a year versus a year. And we think there's greater challenges ahead if prices don't improve. And then I think behind all of that, what does this all mean? And maybe there's new activity, but what really has happened over the last several years is capital structures and energy-related credits. As Colt had said, lending activity's been prominent out there, and what we see is it was cheap. There was a lot of leverage available, and so the capital structures of a lot of the energy companies out there are more complex. And so, unfortunately, as we don't see in this current price environment the ability through asset sales alone for E&P companies to just transact asset sales in order to kind of solve the issues of their capital structures. And if you can't do it through asset sales, our concern is in this price environment that bankruptcy is likely a more realistic option as you sort through the layers of capital and the priority of capital in the capital structure. So we think that's kind of a theme going into 2016. Moving on to traditional C&I loans, commercial and industrial lending activity. This is a sector of the market that the banks are absolutely aggressively looking to add portfolios and high quality loans. And as a result, pricing and net interest margins are under pressure by the banks. M&A activity has recently slowed. As Colt had said, it's still very good, but it has slowed from 2014 levels as purchase price multiples have increased. And through the first half of 2015, depending on what segment of the market, it can be 9 times plus. As a result of this slowing M&A activity, we've seen a lot of dividend recapitalizations, and dividend recapitalizations remain open for select borrowers. And frankly, what's really interesting out there is, despite their reputation, dividend recapitalizations taking money off the table, there's actually a lower default rate than the original LBO loans themselves. Refinancing volume's down about 25% year over year, and that's really just a function that we've been in this very competitive environment for a couple of years now, and a lot of issuers have already taken advantage of low pricing, and pricing seems to have bottomed out from where it was even a year ago. We expect the market to remain aggressive with abundant liquidity and competitive terms going forward. And then the last slide here, leverage lending activity. And Colt hit on this a little bit, with non-banks really coming in to fill a void where banks have retreated a little bit. But bank regulatory oversight has dampened the risk appetite for more levered transactions from banks. U.S. leveraged loan issuance is down about 35% year over year. Banks still make up about 58% of the financing. Despite the liquidity and the heightened competition, middle market leverage multiples are down from 2014. And this is likely reflective of guidance from the regulators pushing more towards 3 times senior, 4 times total leverage for traditional banks. Those are guidance levels, and that doesn't mean that banks won't go higher on a senior basis or a total basis, but when they do, they have to classify them in highly levered transaction buckets and monitor and set aside capital differently than they would if they fit within these buckets. So you have seen a pullback from the banks in leverage multiples. As Colt had said, there's still M&A activity. There's a lot of money to put to work, and so what you're really seeing as a result of this is equity is a higher percentage of the capital for leveraged transactions. And then where you still have the opportunity to push leverage, the non-bank lending universe is growing, and we're seeing that from multiple resources, whether it's unitranche providers, business development corporations, hedge funds. The Term B market is coming more down market. So there is a universe of lenders that is filling the void where the banks are pulling back a little bit. I think that's it.